This video is about why target date funds suck. Target date funds are in mostly every 401k or brokerage account where you choose a target year you will want to retire and then choose the target date fund with the year closest to that. Although they are simple and cheap, for slightly more work you can save thousands of dollars. Let's look at this Vanguard Target Date Fund for 2060. It has an expense ratio of 0.08%. If you scroll down to the portfolio composition, you can see its holdings, which they just have a U.S. and international total stock indexes and a U.S. and international bond index. It has 54% in the total stock market index fund institutional plus shares. If we Google and find that fund on its own, it has an expense ratio of 0.02%. You can repeat this with the other three funds it holds. It has 36% in the international stock index, which has a 0.07% expense ratio on its own. It then has 6% and 3% in a U.S. bond index and an international bond index, and there are individual Vanguard bond indexes that have those holdings. So what you can do is buy these funds individually and have the same holdings as the target date fund, but with a lower expense ratio.
South Dakota for the 142!
And I'll do a comparison showing how much the difference in fees can add up to, but there are some small benefits with the target date fund being slightly less complicated. You may not want to go look up its holdings and then Google for similar individual funds, but this does only take a couple of minutes. Also, if you are within a company portal, usually they will just have the various target date funds and then less than 10 other options besides those. And of those options, you would have a handful of indexes to easily choose from to more or less replicate the target date fund you are trying to match. The other thing target date funds offer is that they will adjust the holdings for you. This is called its glide path and will basically shift the holdings as the investors grow older to a more conservative approach as the years go on, like having more bonds and less stocks. But if you just go in once a quarter or even once a year and check what the current holdings of the target date fund you are trying to replicate has and adjust your own holdings to have the same amounts, the two portfolios will have similar returns. Back to the Vanguard 2060 target date fund. If I recreate a portfolio with the same holdings that the fund has by buying the four indexes individually, the weighted average expense ratio would be just over 0.04%. So we'll say 0.04%, compared with the target date fund that has the expense ratio of 0.08%. Also, there are cheaper options for regular index funds than what Vanguard offers. And 0.04% doesn't seem like a lot, but let's run a scenario. Let's say you are 25 with 40 years until retirement, and you're just starting to work and have nothing invested yet. You are making $40,000 a year. We'll assume a 5% year pay increase, which would include years where you switch jobs and get a higher than average yearly annual raise. We'll assume you contribute 10% of your salary and the portfolio will get a 7% nominal return. We will compare a portfolio with a 0.08% expense ratio and one with a 0.04% one. After 40 years, both portfolios would be around $1.7 million, but the non-target date fund would be $15,000 higher. But when you retire, you won't be withdrawing everything at once. So then in your first year of retirement, if you're able to live off of the returns and the portfolio stays the same, now that it's grown to 1.7 million, that 0.04% will save you almost $700 for that year alone, and for each subsequent year where the portfolio is around that level. So target date funds don't suck, but you can save money doing minimal work and investing in individual stock and bond indexes. Also, keep in mind there are cheaper indexes than the Vanguard ones that I use for this scenario. That's the video. Like, subscribe, whatever.